Canola is one of the most globally traded oil seeds, and right now it's right at the crossroads of trade policy, geopolitics, and supply chain risk. With Canada and China looking to reset strained relations and the U.S. deeply embedded in North American canola flows, the implications stretch well beyond a single crop. I'm Johanna Bota, and to help us break it all down, I'm joined by Craig Turner, Senior Risk Management Consultant at StoneX. Welcome, Craig.
Hey, thanks for having me. I'm glad to be on today.
So, before we get into geopolitics, can you briefly outline who the main producers and buyers are in the global canola market and how trade flows typically work?
Sure. So the main producers, buyers of canola, Canada is by far the largest producer of canola. They produce about 30% of all canola, but they also export about 60% of the global export market. They're responsible for. The biggest buyer is by far China. And they can buy anywhere they average about 6 million metric tons of canola they'll buy from Canada each year, which can be anywhere between 50, 60, 70% of what they're buying from Canada. So yeah, so China being the biggest buyer and Canada for sure being the biggest producer.
So, as we saw in the news last week, China and Canada are trying to reset these relations. Why is this so important specifically for the canola market?
Yeah, well, as we are just talking here, they're the biggest buyer and they're the biggest producer here. It is a big deal, not just for the ag industry in Canada, but there's also global flows that it affects, whether it be through Australia, the European Union. So I think it also can when you take a look at canola, it's a low acid, product compared to the regular rapeseed coming out of Europe. It's kind of the highest, really the highest quality of all the vegetable oils, and also the vegetable. It's also for meal. I mean, it is in terms of the crush. Canola meal is going to be probably the preferred meal from dairy operations. So when you disrupt this kind of trade flow where you don't have the high quality canola maybe coming either out of Canada or into China, or even you're taking it and dislocating it in the crush process. It has a lot of things that go downstream, whether it be canola meal for dairy or the industrial side, and specifically to the renewable biodiesel side also. So by the changing the trade flows, it has a lot of a ripple effect in the global economy too.
Well, let's stay with that then, because with Canadian supply restricted, China turned to alternatives like Australia. So, how effective has that shift been, and what does it tell us about the market?
Sure. So, with China not buying from Canada, they have to make up for about 6 million metric tons of canola from somewhere or a substitute product. Now, before the kind of the tariff wars between China and Canada, I would say China could probably get a little bit under 1 million metric tons from Australia. Now, because of the issues that they've been having, Australia's bigger production, and they know there's now opportunity to sell to China. A lot of analysts think maybe Australia can make up for 3 million metric tons. Now, to put that in a bigger picture here, I would say China would probably produce 15 or 16 million metric tons a year on their own. They would get the other 6 that they need from Canada, giving them about 22 million metric tons of, what they need. What they've been doing is producing 16 on their own, maybe buy 3 from Australia. That gets them to 19. So now we've got 3 million metric tons, let's just call it 15% of canola. And do they find other canola around? I mean, India is a producer. There's some smaller producers like the United States does a little bit, but not nearly as much as Canada. Do you go into Europe and, maybe have a little bit of a lower quality, which in some ways you can, but keep in mind, canola is much more higher quality, and in terms of these oil seeds, and especially in the rapeseed market, where the canola is really meant for human consumption, right? And then high quality feed, while rapeseed, when it's crushed, and also the oil is more industrial or goes into the feed mix, right? So there's only so much you can substitute there. So it does put a little pressure on the outside markets. And yeah, so they can almost make up for everything, but not enough. And it's interesting. Will China, basically try to find an alternative? Do they, does it put more pressure on them to make a trade deal because they're going to have to get, actually buy from Canada at some point? So it's an interesting point.
Well, which brings me to my next question. At first glance, this looks like a Canada China issue. So, why does it matter so much for the United States?
All right. Well, that's a great question. So I think if we take a look at really what happened here is it goes back to electric vehicles, and China produces their own electric vehicles, and it's subsidized and it's at a cheaper price, and Canada has its own electric vehicle market. So does the United States. You can look into it. Maybe the U.S. and Canada were trying together to maybe put a little pressure on the Chinese EVs coming in, and you did see part of that was Canada putting that 100% tariff on Chinese, electrical vehicles, whether it be for trade protection or, or whatever it may be. That's what happened. Shortly after that, or not too shortly, but after that, China basically came out and said there's gonna be, an anti-dumping probe, right? Then they increased their tariffs, I think, to 85% on Canadian canola. So in the if you look at it just on the surface, it is a Canada China issue, but it is lumped in with the United States. And as we see, just recently we're hearing about a trade deal being put together between Carney, the Canadian premier, and China here, and it has a lot to do with the trade relations between the three. Geopolitically, it has a lot to do with China's response to what the United States was doing in Venezuela. Now they're gonna come here into Canada and make nice and, be an economic partner with Canada. So, in the United States' hemisphere. So it's not just a Canadian Chinese issue.
Right. So, keeping all that in mind, and given the trade tensions and the tariffs and the geopolitical uncertainty, what should producers, processors, and end users be watching most closely in the months ahead?
All right, that's another great question. So, what is interesting here is, in the past, when there's been trade issues, let's say between the United States and China, it took a year, almost 2 years to figure out. This one between Canada and China got figured out very fast in negotiations. Which, if China then does start to ramp up canola purchases, not just because they need the canola, but to strengthen their economic ties over with Canada, kind of put a wedge in between Canada and the United States. You could see, the prices increase pretty fast. Now, canola has 4 million metric tons. If you take a look at the balance sheet, there's about a 4 million metric ton surplus in the canola balance sheet, which is big. That is a bearish number. The thing is, can China could wipe away that 4 million metric ton surplus in one marketing year if they went back to buying 6 million metric tons. So right now, while canola has been trading in the high 500s per ton, so let's say mid 600s to maybe 700 per ton Canadian, if all of a sudden China becomes a very active buyer and the biggest buyer in there, it certainly can cause the canola to go up. And another thing too with canola, it's very difficult to replace, right? Because it
Right.
is the feed of choice in the dairy market, and it is going to be the highest quality of oil out there. That's good, the canola oil. You can't, it's the same thing with wheat. You can't blend up; you can only blend down. The same thing in that oil and meal market. So if I am a buyer of canola meal, canola oil, you really do need to, with these prices at the lower end of the spectrum over the past 4 or 5 years, it makes a lot of sense whether you're going to use collars, whether you're going to, you know, use the futures markets, protective calls. But it looks like to us the downside is limited. The lows are probably, last year's lows were in the mid to high 500s per ton. We're in the low to mid 600s. If you take a look at the highs over the past 4 or 5 years, 1,000, 1,100, 1,200 per ton. So if that is the greatest of the trading ranges, 550 to 1,200, and we're sitting here at 650, Um, yeah, it makes sense. It makes sense. You'd want to be more hedged than not going into this marketing year.
Understood. Craig, thank you so much for your time. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.